Ladies and gentlemen, good day and welcome to Ashok Leyland Q4 FY23 earnings conference call hosted by Motilal Oswal Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jinesh Gandhi from Motilal Oswal Financial Services Limited. Thank you and over to you.
Thank you, Ranju. Good afternoon, everyone. On behalf of Motilal Oswal Financial Services, I would like to welcome you all to fourth quarter and FY23 post-results conference call of Ashok Leyland. Ashok Leyland is represented by Mr. Dheeraj G. Hinduja, Executive Chairman, Mr. Shinu Agarwal, Managing Director and CEO, Mr. Gopal Mahadevan, Whole-Time Director and CFO, and Mr. K.M. Balaji, Deputy CFO. We would like to thank the management for taking time out for this call. I would now hand over the call to Mr. Hinduja for his opening remarks, post which we will start with Q&A. Over to you, Mr. Hinduja.
Thank you. Good afternoon, ladies and gentlemen. It is a pleasure to have you at the Ashok Leyland Q4 FY23 earnings call. I thank you very much for the interest shown in Ashok Leyland. At the beginning of the year, we have set out to achieve the following objectives: improve our market share on a pan-India basis, continue to launch industry-leading products, refresh and strengthen our network, grow our non-MSCV business, improve operational efficiency and reduce costs, drive bottom-line improvement, generate cash, improve returns, and improve the performance of our subsidiaries. I'm happy to state that we have been able to check all the boxes, and the strategy will continue in the coming year as well. We continue to be the most profitable CV company in the country today, and we will continue to pursue leadership on that front along with growth in market share. Speaking on market share, FY23 has been a remarkable year as we enhance MSCV market share across regions and product segments, which was done profitably. At the end of the year, our MSCV market share was at 31.8%, 4.7% higher than the previous year. The AlphaStreet range has been a true differentiator and instrumental in the growth of MSCV business. We have grown the share in MSCV in NAV, haulage, tractor, and tipper. While we gained market share in ICV trucks by nearly 5%, we are now focused on expanding the ICV range to enhance our presence further. This is clearly an opportunity for us. We are also very well geared to capture the opportunities in CNG when the market opens up again. As we shared with you at the beginning of last year, the bus market is fast expanding. With COVID lockdowns behind us, we are witnessing growth in all segments of bus market as well. As with trucks, we plan to expand the bus portfolio, especially in the ICV range. We will pursue market share growth by filling in product gaps and expanding our network. The focus now is to expand market share in the north and east, where we believe that we can scale up to 30% in the first stage. This will help Ashok Leyland reach the mid-30 market share point. While our international business saw a volume growth of 2.5%, you must view this in the perspective as other large players witness a decline of 30 to 40% in export volume. FY24 should see further growth in exports as well. All non-MSCV businesses, such as aftermarket and power solutions, have shown healthy growth. LCV market share was marginally down by 0.7% over FY22 due to chip shortages experienced at the first half of the financial year. Going forward, we will be expanding the LCV network in the non-south region, and this should help for further growth. Research houses have predicted a growth of CV TIV of 8 to 10% in FY24. We believe this is very much possible. Ashok Leyland's aim will be to beat the industry growth. FY24 CV demand is likely to surpass the previous peak of FY19. The growth in PIB will be supported by government infrastructure spending, strong replacement demand, and a healthy traction from core industries like steel, cement, and mining. CRISIL expects 88,000 MHCVs and 57,000 LCVs to get replaced in FY24. As mentioned, bus sales is set to grow at a faster pace due to sharp increase in mobility post the pandemic. Further growth is possible with enforcement of scrappage policy, as well as increasing urbanization and replacement of the JNN URN buses bought in FY10-13. Tonnage addition is expected to further improve due to better product mix. That is trend of higher growth in MAV and tractor trailer demand. Factors driving the long-term MHCV sales will be A, improvement in industrial activity in the country, B, steady agricultural output, and C, the government's focus on infrastructure. Commodity prices are expected to soften in FY24, and this tailwind, along with better realization, should help industry margins to improve further. Ashok Leyland will continue its market share enhancement, revenue optimization, cost reduction, and cash flow management, and aim for significantly better financial outcomes in FY 2024. Also, Expo held at Delhi in January this year provided a great opportunity to demonstrate our technological readiness for the future. Switch's presence is growing, and I'm happy to share that our products are performing extremely well. I will now quickly run you through the Q4 and full year performance. Q4 revenue stood at a record rupees 11,626 crores, 33% higher than the previous year. Q4 EBITDA of rupees 1,276 crores was 11% as against 8.9% in Q4 last year. Q4 PBT before exceptional items has more than doubled to rupees 1,068 crores as against rupees 528 crores in Q4 of last year. The PAT before exceptional items was rupees 695 crores versus rupees 431 crores in the previous year. The company generated cash 2,286 crores during the quarter, and AL was net cash positive by rupees 243 crores at the end of FY23. For the full year FY23, revenue stood at rupees 36,144 crores, which is higher than last year by 67%. This is actually the highest ever revenue recorded by Ashok Leyland. EBITDA is almost tripled and stands at rupees 2,931 crores, that is 8.1%, up from rupees 995 crores, which was 4.6% last year. Profit after PAT, profit after tax, after exceptional items for the year, has gone up 2.5 times and is at rupees 1,380 crores versus rupees 542 crores in FY22. Operating working capital is negative at 232 crores as against negative of 1,565 crores for last year. Capital expenditure for the year is at rupees 502 crores against 400 crores in the previous year. Net debt as of 31st March 2023 was negative at 243 crores as against 720 crores at the end of FY22, making it a cash surplus company. I wanted to share two final points with you before I open the floor for questions. One, we remain very positive and optimistic on the future of electric vehicles, and Switch is very well positioned compared to many of its global competitors. Two, going by the positive developments in the industry, we believe Ashok Leyland is well poised to deliver double-digit EBITDA margins in the current year, and we plan to aim for mid-teen EBITDA targets in the medium term. Thank you.
Should I open the floor for questions?
Yes, please do.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Chandramouli Muthiah from Goldman Sachs. Please go ahead.
Hi, good afternoon. Thank you for taking my questions. My first question is on the other expenses line. I think there's been some impressive control quarter on quarter. The other expenses have grown 22% QOQ versus top line, which has grown close to 30% QOQ. So if you could share some color on the drivers of the expense discipline and what sort of run rate we should consider heading into the next fiscal.
See, Muthiah, very quickly, you see, as I mentioned and as Dheeraj had mentioned, we have been having considerable amount of, cost, I won't say reduction, but optimization. So we've been actually channeling the, overall expenditure into the right things and administrative overhead, right, typically, which is part of, the other expenditure, which is approximately about a 600 crore spend, okay, I mean, give or take some crores. This is something that we have actually been able to retain it at something like 15, 16, 16, 17 levels without inflationary impact. So that has been very crucial for us. And middle line management. So we did three things. If you notice in the current this year, what has been special about the company's performance? EBITDA margin in Q1 was 4.4. It went to 6.5 in Q2. It went to 8.8 in Q3, and then it was 11% in Q4. So you could see three things happening: steady improvement in margins and faster rates of improvement in margins. This was happened because of realization improvements, operating leverage because of higher volumes, and that operating leverage has happened because we have been able to rein in the expenses. So it's for us to tell you exactly what you can budget is not what we can share with you, but you can do a trend line now going by the last 4 quarters or even for the last few years, because what has happened is we are forecasting about as Chairman mentioned, and I'm sure you're going to hear Shinu also say this, that we are expecting the industry to grow this year, right? I mean, all the rating agencies have also mentioned that there is a 10 to 12% growth. When that happens, what we would want to do is to ensure that we secure operating leverage on that growth and improve the bottom line further.
Got it. That's helpful. My second question is on the prevailing structure for the EV business. So is there potential for EV buses to be sold maybe to a third-party leasing company, which can in turn sort of lease them out to the various municipalities and states so that there is maybe less capital blockage at the CV OEMs? Is this a business model that can be worked on like the way aircraft leasing works today?
Dheeraj, should I take it?
Sure, go ahead.
Yeah. No, so I think, see, the first, there are, again, I would put 2 large mega trends in this. One is EV business is here to stay. It is here to stay and grow. And you are going to see a faster acceleration in EV business, which is why, as Chairman mentioned, we are extremely confident about our tapping the potential of EV, and we will continue to invest into this business. It's very, very important for us. The second bit is the EV business is still nascent, and business models are evolving in India, which is possibly different from what is happening in the rest of the world. So one of the first things that happened, which you rightly mentioned, but it has not happened the way aircraft leasing has happened, has been in e-mobility as a service. So we would possibly see even operators buying these vehicles from OEs such as ours, and then having a operating model where they will cater to the requirements of either intercity transporters or STUs, or even within the state, within the cities. So you are going to see, I think these operators are not going to go out of business, right? If the market changes to EV, they are going to swap their IC buses to EV buses, that's all. So we need to cater as an industry, and we are catering, we are making ourselves ready as a company to ensure that we are catering to this segment. The second segment is STU businesses, where we will see a mix of both ownership and e-mobility as a service coming in. And the e-mobility service, as things go further, will start to mature and will become even more profitable as the volumes start to pick up. Thirdly, there would be private sector ownership, where you have the institutions, the schools, and the private operators, which I talked about. So they would start procuring this. See, ultimately, the whole trick about EV is that at the moment the capital cost is higher, but the operating cost is negligible, right? Once these operators and some of the STUs start to secure funding, they may want to actually take up an ownership model. So we are actually keeping ourselves open for all three models.
Got it. That's helpful. Thank you very much, and all the best.
Thank you. Next question comes from the line of Pramod Kumar from UBS Securities. Please go ahead.
Yeah, thanks a lot for the opportunity. My first question is on the current demand environment, because the biggest, concern what the street has is on the CV cycle health, as to where exactly we are, and whether do we have another couple of years of growth, or this is going to be the last year of growth in terms of from a cyclical perspective. So if you can help us understand how is demand looking from your vantage point, especially in the recent weeks and as you look into the next month, because there was reasonable pre-buy in the fourth quarter. That is the expectation. So how's demand looking on the ground, and how would you look at demand from a cycle perspective, and in terms of just extending it beyond FY24 guidance? If you can just help us understand on that.
Yeah, Pramod, I think. Okay, Dheeraj, go ahead, please.
No, I was saying, Shinu, please go ahead.
Okay. So yeah, Pramod, thank you for the question. As Dheeraj said, we are very optimistic about the industry, not just for this year, but we also think the industry could go for a longish positive cycle this time. Even the ground pulse from the customers, from large fleet owners, indicates that this will be a longish cycle. For this year, like we said, most of the research houses are pegging the industry growth, overall industry growth at 8 to 12%. And we also think that the industry growth should be in that direction, at least 10% or more. So yeah, very optimistic. As far as the Q4 pre-buying is concerned, that is a fact. Some pre-buying happened in March, and it may have some impact on April or maybe May. But after that, we think that the growth would be back, and for the whole year, we are very optimistic.
And Shinu, just extending that question. Yeah.
If I could just add in over there just a few more points. And firstly, a lot of our business is very much dependent on the economy. And as you know, India is moving at a very fast pace and is expected to become the third, if not the fourth largest economy. And in that context, the growth will go hand in hand for our business of commercial vehicles, trucks, and buses. Also, one other issue on international operations, I know we've spoken about this many times, but I'd like to emphasize that during the course of the last year, our traditional markets of SAARC completely crashed. And irrespective of that, we were still able to grow slightly because of the expansion we've done in the Middle East and the African markets. There is hope that during this financial year, many of the SAARC markets come back as well. So I would say that we're optimistic of international sales improving. And as you were saying, looking outward, personally, we feel that the cycles for CV have this traditional growth of 3-4 years. We've only had one good year so far. FY24 is looking good. We don't see any immediate show blockers which should indicate otherwise. And we do feel that this growth momentum should continue beyond FY24 as well.
Yeah, and Dheeraj and Shinu both, as in which are the categories where you're seeing strength which is kind of giving you that visibility. And I understand the fleet industry has got heavily formalized. So I think you can engage more with the large fleet owners and understand the on-the-ground situation. If you can just help us understand pockets of strength in terms of the fleet side, what's working well, and where do you see further upside, like categories like say buses, for example. If you can make some comment on that, that will be helpful.
Well, I would say that, for us in this last year, we have, as I mentioned, we have grown in every product segment. And the growth definitely seems to be across the board, although the LCV segment has not grown as fast as MHCV, and even the predictions for this year are in the range of around 5-6%. But barring that, I think we remain quite optimistic from ICV to MAV, tractors, haulage. They are all showing quite positive signals. Shinu, would you like to add something? And on the buses as well, Shinu, if you'd like to expand that.
Yeah. So Dheeraj, like Dheeraj said, I think this overall momentum will continue in most of the segments. We have done very, very well in MAV, tractor trailers and tippers in the last year, as is evident from our numbers. ICV is, I think, one area where we have a lot of headroom, both in buses and trucks, right? So we are preparing ourselves with beefing up our products, beefing up our network on this. I think in FY24 and beyond, we would like to put an extra focus on ICV segment because of just the headroom available there. I think on the bus side, the growth expectation is actually close to 30% or more, because buses are coming out of a very, very low base after the pandemic. Yeah, so we are very, very strong. Ashok Leyland is very, very strong in the MTV side of the buses. So we hope to gain from that momentum, that growth momentum. Even on the ICV side, as I said, we are putting a lot of more focus now on both trucks and buses. And we hope to gain substantial market share there as well.
Thanks. And Dheeraj, you made comments in your opening remark about margins in the teens. Can you just help us understand that a bit more? Because that's actually quite surprising to hear, given how the cost base has moved for the industry, right? Because in percentages, trying to push margins higher is like actually quite ambitious, given how inflationary the environment has been. So if you can just help us understand what is giving you that confidence, what are the factors which will drive this, and whether the modular transition on the architecture side is also part of that story. If you can just help us get more color on that, sir.
Sure. I think, look, one of the key areas for us that has helped us gain our market share as well as the product performance of the Aptar range in BS6 has been very good. And, we had explained this in the past. The advantage of having this modular program has been that we've been able to rationalize a lot of our supply base, which has led to a lot more efficiency as well. And as Gopal was explaining, a lot of internal cost control has been achieved. And as we see, with the softening of the commodity prices comes in as well, we do feel the opportunities of achieving double-digit EBITDA margins and moving that further into the future should be possible with the volume growth as well. Market share growth, volume growth. We are feeling, going by the performance of the last financial year, quite optimistic in terms of having identified pockets where further cost reduction opportunities exist. And as I said, the product range itself, the modularity does help us significantly.
Thanks a lot, and wish you all the best, sir. Thank you.
Thank you.
Thank you. Next question comes from the line of Mukesh Saraf from Avendus Spark. Please go ahead.
And thank you for the opportunity. Just in continuation to the previous couple of questions on paddy industrials, could you give some sense on the current, say, in FY23, how was the replacement mix versus, say, new fleet addition mix in terms of the customer profile? And typically, with your experience of the previous cycles, how does this mix change as you approach the end of the cycle? Could you give some sense of that?
Well, it's an interesting question, but this industry is still a little bit unorganized. But I think there are three things that we have to remember. In FY22-23, one of the key things that has happened is there possibly has been increase in primary demand. Okay, the primary demand has come in because for the last 2 to 3 years, if you notice, there has not been any major demand at all, right? After FY19, we thought that FY20 will be a great year after, before the launch of BS6, but it was a flattish year. After 2021, 22 were virtually kind of, there was no real demand. So to answer your question, our internal estimates tell us that a lot of this has actually come from primary demand. That is why we are also optimistic about, at this point in time when we're sitting in the month of May, we are optimistic about the growth in 24. You know why? Because of 2-3 reasons. One, the mix of, large fleet operators versus first-time buyers, first-time users, the tilt is in FY22-23 has been more in favor of large fleet operators. The full as first-time users has not come in because of 2 reasons again. One, they are also waiting for the industry to mature, demand to keep going up. The second one is interest rates have also been high, right? So we are actually yet to see the full potential of first-time buyers, first-time users coming into the market. The second thing is the replacement demand will start kicking in now because we believe that, just as Shinu had mentioned or Dheeraj had mentioned, I think this industry has a bit of potential because what is happening is on one side, there is a lot of, regulation coming in on environment, pollution, ESG, the government is pushing for clean energy, etc. On the other side, we are a country where you have vehicles from BS2 to BS6 flying. We do not, and the third aspect of it is that the government itself has visibly started the scrappage policy, but it is for maybe government-owned vehicles at the initial stage. But what is going to happen is this catch-up is going to happen, and in the years to come, in 20, possibly it will start in 24, it may go to 25, 26, you are going to see the replacement demand kicking in. And you will see that, that is going to be one more aspect that will drive the CV demand. What the growth rates are, little difficult to tell, but the other tailwind that may come up is we have seen the peaking of interest rates, and even with the high interest rates in the last year, what has been surprising has been the level of demand that has come in, right? I mean, the last year the industry has grown at about 40% or so, and this has been with a certain amount of challenges built into it. This year, in macro terms, will be relatively easier, but with a higher base. But even with this, if we have a 10 to 12%, it's a very good thing for the industry.
Sure. Thank you for that. And secondly, on pricing, could you give some sense on what kind of price hikes we have taken so far, and how was the absorption of that price hike in relation to how the discounts are moving?
Yeah, I think, firstly, I would like to say that there is a big realization in the entire industry that our industry is going to change in the years to come, right? I mean, therefore, all the players like Ashok Leyland have to invest in the future, and for that, we cannot just remain at the levels of EBITDA that we are as an industry, right? I think that realization is definitely there, that we have to increase our profitability levels. Now, in terms of price realization, like Dheeraj explained, I have been in the market myself visiting a lot of customers and dealers. And definitely this new modular avatar platform based products are being accepted very, very well. Especially in the higher tonnage, in the tipper, in the tractor trailer and MAV segment, there is a lot of pull because of this new platform. And on back of this trend, we have been able to have much better price realizations last year. And I think we still have headroom there, right? I mean, we will play it by the market, how the market behaves. But definitely there is an opportunity there. There is no doubt in that.
Sure, that was helpful. Any numbers you would like to give on the price hikes taken so far in the month of April, May?
April, we took about a 2% price increase. See, just like Shinu mentioned, what is happening, unlike in the past, is the retention of the price hike is almost 80 to 90%.
Okay.
So we are not increasing the price and increasing the discount. The industry is also not doing it. And you folks know it. In Leyland, we have never been actually, wanting to do this as a leading practice. So for us, we are extremely happy about the outcome because this has been a great year for the industry. And why should we sell it at such, low margins? There is no necessity for it. For the industry to be sustainable, we need to improve pricing, and we are seeing that happening in the current year. And I would also add one more positive in this. I mean, not to sound overly positive, but these are facts that all of us know. One is pricing retention has been better. The second one is commodity prices seem to be coming off, right? So if the industry were to deal with this intelligently, it should actually shift margin base to the next level. That's what should be the outcome of this. Let's hope it happens.
Right. Sure. Thank you for that. I'll get back to you.
Thank you. Before we take the next question, a reminder to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Gunjan Prithyani from Bank of America. Please go ahead.
Yeah, hi. Thanks, team, for taking my questions. I had 2 questions. First is essentially a clarification on some of the comments that you've made. 2% price increase in April, does this pertain to the BS6 phase 2 RD transition?
Hi, Gunjan. This is Shenu. Yes, I mean, we have some impact of OBD2 norms, but not a big impact. But this is a general price increase to cover, to cover rising cost as well as to increase our.
Okay, so the RD-related cost is fully passed through?
Yes, it is.
Okay. And the second clarification was on this commodity pricing cooling off. I just wanted to get an understanding as to how much of the tailwind from commodities we saw in Q4. And when you are looking into the next 1 or 2 quarters, are we seeing there is some pending benefit still to come in because of metal corrections, steel contracts, whatever that you have visibility on?
Hey, Gunjan, what has happened is last year the peaking happened in the beginning of the year, where there was a huge increase and all of us were expecting steel prices to go further and further up, etc. But then we found there were a confluence of both domestic and international factors which resulted in the pricing cooling off a bit. But again, in the fourth quarter, the challenge was that coking coal prices started to shoot up. And then then the steel prices started to inch up a bit. What is happening is, as you know, in this industry, especially when buying of steel is concerned, there is always a, kind of 2-month quarter lag in the settling of the prices. So we expect that when we settle the prices, there could be a little bit of pricing done on the Q4 range itself, or maybe it's slightly lower. But after that, we know that China's demand has cooled off again significantly. There are other countries like Australia which are waiting to export out because they are also seeing a domestic glut there. So we are the outlook on steel prices for the current year is that we would see prices coming off in Q2, Q3, Q4 itself. So if this were to happen, which is going to be pretty good for us, because the industry, benefits immensely from steel price reduction.
Okay, got it. That's helpful. My second question is on this investment that you've called out on the switch mobility business, which is 1,200 crores progressively. And there's about 200 crores, some ICDs in this quarter itself. So, just a clarification, does this pertain to switch? And I want a broader understanding of, we were looking to raise money externally and now we're looking to infuse this capital. This will be done over how long? I mean, if you can quantify the period, and what will these investments go towards? Some color around that will help.
Well, let me first clarify this. Maybe we should have called it a short-term loan or, a loan instead of calling it ICD. This is only for switch, okay, for the operations of switch. There is a lot of integration, by the way, between the operations of switch and Ashok Leyland in India. As I told you, one of the most important, you heard Chairman say that he is very extremely bullish about switch. Why are we talking about that? First of all, because switch is backed by a 75-year-old experienced MSCV player like Ashok Leyland and one of the world's largest bus manufacturer, and with its own networks, relationships, understanding of the product, understanding of the applications, etc. Right? So this is certainly a benefit that switch is having, and that is how switch is actually gaining acceptance very quickly in India. Now, the second bit of it is, while we are looking for investors, what we said is while we will continue to look for investors, we would want to ensure that the business plan of Switch continues, is on track. Because for us, this is not just another company. This is we're trying to kind of address the future of Ashok Leyland. While IC will continue and continue for a long time, EV is going to gain more and more traction, and maybe even H2Is for that matter, right? Alternative forms of energy. Now, when we are doing that, we want to ensure that we are able to fund the operation. So to answer your question, yes, the 200 crore which was given earlier, which was declared, is the loan that is given to Switch India. We will now the investment horizon that we are looking at, which Chairman did mention about 1,200 crores, will be spread out in tranches maybe over next 12 months. We will again revisit this. But what we want to ensure that the balance sheet of Ashok Leyland is very strong, right? And we have the ability to fund the expansion of Switch, and we will continue to do that.
And this is largely towards technology. Yeah, sure, go ahead.
Yes, I was just going to add in. Most of this funding would be needed for completion of the programs of the new product, and I think one of the most significant products that we would be launching, and the first sale will be going into Spain in January, is a brand new development of a European 12-meter bus. I think we would probably be the first electric Indian player to have developed a whole new platform. And we remain quite optimistic because this 12-meter bus has the potential for not only the European market, UK, Europe, and the Middle Eastern markets as well. So this year is a very high capex year for Switch, predominantly for the new products, the two new LCVs, electric Dose, electric Varados. You've got the low-floor 12-meter bus and the low-floor 9-meter bus for the Indian market, and then the low-floor 12-meter E1 bus for Europe.
Got it. This is very helpful. Thank you so much.
Thank you. Next question comes from the line of Kapil Singh from Nomura. Please go ahead.
So good afternoon. Congratulations on a good set of results. Could you share your first on investment plans for FY24 and in what areas they will be going? Overall consolidated numbers.
Yeah, so, yes, we want to.
Yeah, I mean, normally as a company, we spend about 500 to 600 crores in capex. In FY24, the amount is a little bit higher. It's going to be roughly 600 to 750 crores in capex. Some of it will go towards capacity augmentation and debottlenecking of our supply chain, but that would be not a major amount because we have enough capacity right now, at least for next 1 or 2 years. I think most of the capex would be on product development, and as I said, we have earmarked certain areas or certain product segments where we need to beef up our product offerings, including international markets. So most of the capex would be there. Also, as you know that in Auto Expo this year, we displayed a vast range of alternate fuel vehicles across the range, ICV, MDV, buses, LCV, etc. So that capex has been going on for the last couple of years, and we just want to accelerate that further so that we can bring these products in the market in the next 1 or 2 years.
And so investment plan?
No, so investments I think predominantly will be in Switch, which I think is what is being planned. Other than that, I don't see any major investments. I think Hinduja Leyland Finance is already well funded. They had 900 plus crores of qualified institutional placement being done. So we are not seeing any major investments coming in. Maybe a small investment here and there to sustain some of the smaller subsidiaries.
So what is your consolidated net auto debt?
Consolidated what? Sorry?
Net automotive debt, excluding the financing business.
Consolidated debt, is it?
Net automotive debt.
Balaji, can you just share that? Balaji will just share it. Maybe you have any other question while he takes that number out?
Sure. So on EVs, I just wanted to check for Switch. We are investing with 12 billion next year. from when will the revenue start to flow, and what kind of profitability do you expect from this business to start off with? Is it gross profit positive, EBITDA positive? Any color you could give there? Anything on the order book that it has so that we can build revenue against this investment?
Well, you see, as far as this is as Dheeraj had mentioned, we have variants to be launched, products to be launched in light commercial vehicle, 2 variants, and then we have the 9-meter and 12-meter launches in India as well as in Europe, right? And these investments are going to take up quite a bit of the portion of the investment that we are planning into Switch. All we can tell you is, see, the market is evolving. So in the initial period, one can't expect it to straight away become EBITDA positive from year 1. But in the medium term, this business is profitable just like, IC business. Or we can possibly have greater color and share that with you in the later part of this year, because it's a little too early to share numbers with you. But all we can tell you at the moment is Switch is not, Switch has got volumes already. It is actually doing both direct sale, which is not very significant, but e-mobility as a service. We have supplied to BMTC, Bangalore Municipal Transport Corporation, Chandigarh Municipal Corporation. Then we have started supplies for BEST. We have a couple of private orders also where they are looking at e-mobility as a service. All we can tell you is that, and this was, don't hold me to the date, I don't have it readily, but I think 3-4 years back, we were one of the first to start the whole EV, e-mobility as a service with the Gujarat Ahmedabad, bus transport authority, and then followed it with Bihar. And what we can tell you is that with each passing order, we're getting better and better at this. We are actually extremely confident about the performance of the product, and more importantly, also about the uptimes of these products. The uptimes of these vehicles is at 99%. So it's something that we have understood and are able to do very, very efficiently. While we will continue to pursue and Switch will continue to pursue and sell direct sales. With the launches of a larger product portfolio, we believe that the traction in the business will start to gain faster. And the market is also evolving, because year on year now the market has started to grow. So we'll have to wait for the growth in the market to happen, over the current next couple of years, and you will see that the EV business volumes will start to scale up.
Thanks, Gopal. Wish you all the best.
Thank you.
Thank you. Next question comes from the line of Pramod Amte from InCred Capital. Please go ahead.
Yeah, hi. Thanks for taking the question. So this is related to your new products and market share ambition. If I have to look at, you have recently got back your oldest customer and the largest fleet operator as a comeback client. Wanted to know, is it more of a reassurance of your new product, or it's still a pricing game being played in the marketplace? That's one. Second is, if I have to look at your market share on overall CV, you are at 2-decade high with the success in LCV. So what are the new product launch timelines in the coming quarters and your ambitions on the market share in the short to medium term?
Are you referring to the VRL order? Sorry, I was just clarifying. Were you referring to the VRL order?
Yeah, exactly.
Okay. Yeah, please go ahead, Srinath.
Yeah, VRL order, we are very, very proud to get them back. They have been associated with us for many, 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 many years. I think, there are a lot of factors, not just one. I think one is just the relationship itself, and the other is, of course, the products are speaking for themselves in terms of performance and reliability. And also, I think it has got a lot to do with the after-sales network also. The kind of service they have been experiencing from Ashok Leyland. I think it's on multiple accounts that we got that order back, and we are really proud of it. What was your second question about?
Second one was related to your short to medium term market share ambition, because you're already at a 2-decade high on the overall CV market share, if I have to look at near 18%. And how does the new product launch pipeline or timeline is to support these ambitions?
Yeah, see, as Dheeraj had also said in his opening statement, confident that, to stay beyond the 30 now. But our goal is to get to mid-30s in the next few years, in the near term, right? So that is what the focus is, and the reason for that confidence is also very clear. I mean, not just the product story, but also, the big laggards, like in our journey, were mainly the North and the East markets, right? But if you see our market share in North and East in FY23, we have had a favorable, very significant jump, roughly about 4 to 5%. While we grew in all the zones, but we are really happy about the North and East growth in our market share, which is already like touching 24, 25% now. In the past, you would see, like even in FY22, we were kind of 20 or below 20, right? So that is giving us a lot of confidence because the network is shaping up. We have the right profile of dealers coming up in the right places. We are setting up, we are investing a lot in our service reach as well, and customers have started appreciating that. So that gives us the confidence, not just the product, on the product side, on the success of the Avatar modular platform, but also that we have been able to place the right set of dealers in the markets where we were traditionally weaker.
Sure. Thanks and all the best.
Thank you. Next question comes from the line of Shubham Shukla from Voyages Capital. Please go ahead.
Yeah, hi. Good evening, everyone. I hope I'm audible.
Yes.
So my first question is about our debt level. Like, how much is our gross and net debt, like, so far? And where do we see this going forward?
Yeah, I think Balaji will answer that. While he's picking out the number, let me tell you that the whole strategy of the gross and net debt has been that we conservatively manage the debt to ensure that long-term debt is funding the long-term plans of the company. And we don't continue, we don't use this aspect of when the cash is there to prepay the debt and then borrow, etc., because we would want to see consistent cash flows in the company, right? So what is happening, the long-term debt is about 3,200, is it?
2,900 crores.
Okay, go ahead, Balaji.
Long-term debt is at 2,900 crores.
Okay. And you are asking the short-term cash?
Short-term cash is 3,150 crores.
Okay. And our average cost of funds, if you could provide?
We'll tell you, but what we have done, while we can't give you that exact number at the moment, I'll tell you that the treasury team had done a good job in locking some of the, some of the debt at fixed rates when the interest rates were low. So, so some of the debt levels, I'm not saying the overall debt percentage is that, but some of the earlier debt that was taken is at 7.25, which is extremely low when compared to the current interest rates, yeah.
Okay, and later ones are like quite high, like just like slightly higher than these numbers?
It will obviously be gradually high. It won't be very high because we keep borrowing every year, right? We see, irrespective of the cash that is there, because we need to manage long-term and short-term separately, right?
Yes.
So while there could be some amount of carry, etc., it doesn't matter, because what happens is, you must remember, when in a situation like COVID, right, when the entire thing came to a grinding halt, this was this philosophy that actually helped the company. So we were able to not get worried at all about the long-term requirement of the company because that was already funded. What we needed was short-term money, which could be got either through short-term loan or commercial paper, and we were able to get some of the finest rates. So going forward, I don't see an issue on the debt profile of the company, because our, even on a net basis, even last year, our debt equity is hardly I may be wrong in this number, but it's 0.2 or 0.25. So there's sufficient headroom for us to borrow if there is a necessity. But see, at the rate that the industry is growing and with better improved margins, I believe that the pressure on the balance sheet for going in for debt will also be much lower.
Okay, thank you. And on the capex side, like how much capex we have in this quarter four last year?
You want the quarter or full year?
The quarter four. Like full year, I'm assuming it was supposed to be 600 crores for the year, and like so far Q3.
Q4 was around 180 crores.
Full year was close to 500, not 600. Not 600, it was 500 crores.
Okay.
Believe me, that is extremely efficient management. Please understand, when a company is delivering, what I wanted to share with you is at 36,000 crores of revenue and at these levels of volumes, I think the manufacturing, operation and product teams have done a great job in actually reining in the capex at just about 500 crores. That's very, very important for, to note, and be very clear that while we will ensure that we are invested for all future growth, right? And we are not going to shortchange the future for the present. So we will invest. But we are very, very clear that the whole organization is actually driving towards productivity, not only in revenue maximization, cost efficiency, but even in capex. So the operating teams are actually working at doing how do I get better productivity out of this capex, out of this facility. And that is why we're seeing this trick of this 500 crores, such a lot, which I won't use the word term trick, but I'd say the outcome of just 500 crores of capex on a company such as Leyland.
Okay. Thank you so much. That's quite assuring. Thank you. That's been that.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. A reminder to all the participants that you may press star and 1 to ask a question. A reminder to all the participants that you may press star and 1 to ask a question. Ladies and gentlemen, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you for your questions. I think I would just like to emphasize a few areas that I believe that I've heard that are of concern. One is the continuing growth of the commercial vehicle cycle and whether beyond FY24 the market will continue on a stronger note or not. Our firm belief is yes. We believe the Indian economy is growing quite strongly, and in conjunction with that, the commercial vehicle market will continue to grow as well. I also believe there are concerns with regard to Switch and the investors coming into Switch. I think it's important to note that whilst many companies have started electric vehicle divisions, we are one of the few that have successfully new products and which are running well. We have a further 2,500 confirmed order book for vehicles to deliver, and we are one of the few companies that are operating in multiple geographies from India, SAARC, Europe, UK. And we're very confident that we can grow this business very robustly for the future. And finally, seeing the performance of the last financial year, we would like to emphasize that we remain very optimistic on our ability to perform equally well in the current year, to grow our market share, and at the same time do it on a profitable basis with strong EBITDA performance as well. So thank you very much once again for your interest. Shinu, anything else you would like to add?
That's it, Dheeraj. Thank you very much, everyone.
Thank you.
Thank you. On behalf of Motilal Oswal Financial Services Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.